A Roth IRA is one of the best retirement accounts you can have because it lets you earn interest on your money tax-free. This means your money will grow and you won't pay taxes on any of the growth when you take it out for retirement. Roth IRAs also give you the flexibility to withdraw the money you put in. Everybody has a bank account and a debit card. Everybody should have a Roth IRA. More than 35% of US households have an IRA. Of those accounts, nearly 21% or 26.3 million are Roth IRAs. The idea is to save money for your retirement with a Roth IRA. That means that one day you'll withdraw your funds to replace or supplement your other income. If you pull your money out too soon, not only will you lose out on years of compound interest amounting to potentially thousands of dollars, but there may also be penalties to consider. Before we get into the Roth IRA withdrawal rules, know that you can withdraw any amount you have contributed into the Roth IRA without penalty. The real question is whether you want to. In 2022, you can contribute $6,000 annually into your Roth IRA if you're under 50, or $7,000 a year into your Roth IRA if you're 50 or older. Keep in mind there are income limits. If you file as a single person, your modified adjusted gross income, MAGI, must be under $144,000 for tax year 2022. If you're married and filing jointly, your MAGI must be under $214,000 for tax year 2022. If you exceed these income limits, you can still contribute. You just have to do what is called a backdoor Roth IRA, which is using a traditional IRA conversion to deposit the money. This is a totally legitimate way to deposit your $6,000 into your Roth. You contribute after-tax money into a Roth IRA, which is the money you're already paid taxes on. There are zero penalties to withdraw the funds you initially put in, but that does not include earnings or interest, which are considered profits. If you start tapping into your earnings, you may be taxed or incur a 10% penalty depending on your age and situation. Experts agree it's best not to tap into your Roth IRA funds unless it's absolutely necessary. Unlike a traditional IRA, which has required minimum distributions, RMDs, starting at age 72, a Roth IRA doesn't have these requirements. This means you aren't forced to take money out of your Roth IRA after reaching a certain age, so your earnings can grow tax-free for as long as you wish. This only applies if you are the original owner of the accounts. So what if you're under 59 and a half years old? Retirement accounts are intended for just that, retirement, which is defined as beginning at age 59 and a half for those account purposes. If you withdraw your earnings and gains before this age, you'll pay a 10% penalty and income taxes, but there are qualified exceptions. Remember that you have the option to withdraw your initial contribution without penalty, but again, you don't really want to because you want that money to grow. Plus, since you are only allowed a certain contribution a year, if you pull your money out, you'll never be able to put it all back in. If at all possible, use money from other sources like an emergency fund so your investments can grow tax-free. So what if you're over 59 and a half? If you've had a Roth IRA for more than 5 years, you can withdraw your contributions and earnings without taxes or penalty at any time when you're over 59 and a half years old. This is why Roth IRAs are so special, so invest early and often if you can. But what is this 5-year rule for Roth IRAs? There are 3 5-year rules that all Roth IRA owners must adhere to or pay taxes or penalties. The first is that you must wait 5 years from when you made your first contribution to avoid taxes or penalties on your earnings. If you're 59 and a half, regardless of your age when you open the account. The second rule says that you must wait 5 years before you withdraw any Roth IRA funds from conversions into your account. If you have several conversions, IRS rules state that your oldest conversion gets withdrawn first. If you're under 59 and a half and make a withdrawal before 5 years have passed, you'll pay a 10% penalty unless you qualify for an exemption. The third rule is for those who inherit a Roth IRA. You're required to empty the account within 5 years, either spending it over time or with a lump sum. Either way, there's no penalty on contributions or earnings if the account is more than 5 years old. There are stiff penalties of up to 50% if you take longer than 5 years to empty an inherited Roth IRA. So this is a 5-year rule you'll definitely want to remember if you find yourself in this situation. So then how can you withdraw from a Roth IRA early without a penalty? While Roth IRAs are not intended to be a savings account, Roth IRAs do allow you to withdraw funds without the 10% early withdrawal penalty, but only for a number of exemptions. If you meet the 5-year rule, you won't pay taxes on these withdrawals if you're over 59 and a half. But if your account is younger than 5 years, you'll be responsible for income taxes on the earnings portion, not the contribution portion, which never has taxes or penalties of your withdrawal. Here are some of the exemptions to early withdrawal rules. You can be considered a first-time home buyer if you or your spouse hasn't owned a home in the previous 2 years. In that case, you're eligible to withdraw up to $10,000 from your Roth IRA to buy, build, or rebuild a home. You're also able to use the money for a parent, child, or grandchild who fulfills the first-time home buyer criteria. But remember that the $10,000 is a lifetime maximum, and once you have that money, you have 120 days to spend it on eligible expenses. Then you can withdraw up to the amount of your yearly higher education expenses for yourself, spouse, children, grandchildren, or great-grandchildren to pay for qualified expenses at a college, university, post-secondary education, or vocational school. This includes tuition, fees, books, supplies, room and board, and other required equipment or material. And then the IRS says there are other exemptions, including total and permanent disability, unreimbursed medical expenses that exceed 10% of your adjusted gross income, health insurance premiums if you're unemployed, qualified expenses related to birth or adoption up to $5,000, qualified disaster recovery, military leave of at least 180 days, IRS levy, death, and a few other reasons. Remember, this only works if you withdraw your contributions, not your earnings. Keep in mind you have until tax day of the following year to make contributions for the current year up to the annual limit. If you withdraw contributions from previous tax years, you have 60 days to return the funds to avoid penalties. So what are your thoughts? Are you going to withdraw from your Roth IRA anytime soon? Comment below. And as always, take care of your money.